Coffee can investing is a long-term investment strategy that is based on the principle of buying and holding a diversified portfolio of high-quality, undervalued stocks for an extended period of time. The strategy gets its name from the idea of putting your investments in a coffee can and forgetting about them for years, similar to how one might put money in a coffee can and forget about it for a long period of time. The idea is that over time, the stock market will eventually recognize the true value of these undervalued stocks, leading to substantial returns for investors who have held onto them for the long term. The strategy is often used by value investors and contrarians who believe in buying assets that are currently out of favor with the market, but have a strong potential for growth in the future. The concept of coffee can investing is relatively simple, but it requires a long-term investment horizon and a disciplined approach to investing. At its core, the strategy is based on the idea of buying and holding a diversified portfolio of high-quality, undervalued stocks for an extended period of time. The goal is to find companies that have a strong track record of performance, a durable competitive advantage, and are currently trading at a discount to their intrinsic value. These types of companies are often referred to as blue-chip stocks and are considered to be less risky than other types of stocks. The key to successfully implementing a coffee can investment strategy is to identify these undervalued stocks, and then hold onto them for an extended period of time, typically several years or more. This is where the coffee can metaphor comes in. The idea is to put your investments in a coffee can and forget about them for a long period of time, allowing the market to eventually recognize their true value. It's important to note that this strategy requires discipline and patience. It's not a get-rich-quick scheme, but rather a way to build wealth over the long term by investing in high-quality companies that are undervalued by the market. It also requires to diversify the portfolio across different sectors and industries. In summary, coffee can investing is a long-term, value-oriented investment strategy that focuses on buying and holding a diversified portfolio of high-quality, undervalued stocks for an extended period of time. The goal is to find companies that have a strong track record of performance, a durable competitive advantage, and are currently trading at a discount to their intrinsic value. This allows the investors to benefit from the market's eventual recognition of the true value of these undervalued stocks. The advantages of coffee can investing are many and include the following. Long-term perspective. By focusing on a long-term investment horizon, coffee can investors can avoid the short-term market fluctuations that can cause panic and lead to poor investment decisions. Diversification. By investing in a diversified portfolio of high-quality, undervalued stocks, coffee can investors can spread their risk across multiple companies, reducing the impact of any one stock's performance on the overall portfolio. Low turnover. By buying and holding stocks for an extended period of time, coffee can investors can avoid the high trading costs associated with frequent buying and selling. Focus on value. By focusing on undervalued stocks, coffee can investors can potentially benefit from the market's eventual recognition of a company's true value, leading to substantial returns. Emphasis on fundamentals. By focusing on high-quality companies with a strong track record of performance and a durable competitive advantage, coffee can investors can potentially benefit from a company's underlying fundamentals, and avoid the potential pitfalls of investing in overhyped or trendy stocks. Avoiding herd mentality. Coffee can investing is a contrarian approach. It helps investors to avoid buying assets that are currently popular among investors but overvalued by the market. Tax efficiency. By holding stocks for a long period of time, coffee can investors may be able to take advantage of lower long-term capital gains tax rates, leading to a higher return on investment. Here are some steps on how to implement a coffee can investment strategy. Conduct research. The first step in implementing a coffee can investment strategy is to conduct thorough research on potential stocks to include in your portfolio. Look for high-quality companies with a strong track record of performance, a durable competitive advantage, and are currently undervalued by the market. Diversify your portfolio. Diversification is key to a successful coffee can investment strategy. Spread your risk across multiple companies and different sectors and industries. This will help to reduce the impact of any one stock's performance on the overall portfolio. Set a long-term investment horizon. One of the core principles of the coffee can investment strategy is a long-term perspective. Be prepared to hold onto your stocks for several years or more. Avoid frequent buying and selling. The goal of the coffee can investment strategy is to buy and hold stocks for an extended period of time. Avoid the temptation to frequently buy and sell stocks, as this can lead to high trading costs and could negatively impact your returns. Regularly review and rebalance your portfolio. While the goal of a coffee can investment strategy is to buy and hold stocks for an extended period of time, it's important to review and rebalance your portfolio on a regular basis. This will help to ensure that your portfolio remains diversified and that you are not overexposed to any one stock. Be patient. Investing in the stock market can be a volatile process, so it's important to have patience while implementing a coffee can investment strategy. Remember that the market will recognize the true value of your undervalued stocks over time. Keep in mind the tax implications. Keeping in mind the tax implications and regulations of your country is important, especially when it comes to long-term investments. Consult with a tax advisor to understand the regulations and plan accordingly. Here are a few examples of Indian companies that could potentially fit into a coffee can portfolio. Reliance Industries. This diversified conglomerate has a strong presence in the oil and gas, petrochemical, and retail sectors. It has a history of steady revenue and earnings growth and is considered a blue-chip stock. Tata Consultancy Services, TCS. This leading IT services and consulting firm has a strong presence in the global market. It has a history of steady revenue and earnings growth and is considered a blue-chip stock. Kotak Mahindra Bank. This private sector bank has a strong track record of performance and a durable competitive advantage in the banking sector. It has a history of steady revenue and earnings growth and is considered a blue-chip stock. Bajaj Auto. This leading two-wheeler and three-wheeler manufacturer has a strong brand, a diversified product portfolio, and a strong domestic market presence. It has a history of steady revenue and earnings growth and is considered a defensive stock. It's important to note that these are just examples, and it's crucial to conduct thorough research and analysis on any potential stock before making an investment. Also, the stock market is constantly changing, so it's essential to regularly review your portfolio and make adjustments as needed.